So the USD right here, look at this currency. For example, the USD right here, this currency has a base and a quote, right? If you know about currency pairs, currency usually has a base and a quote. The first part of the currency pair is the base, the second part is the quote. Now, when you have a currency pair like this, it means that the euro is on the left, the dollar is on the right. And for currency pairs, they usually have this tug of war relationship, which means the dollar is, if the base currency is strong, if the base against the quote currency. So the first currency is strong against the second one. That's the reason why that's why the asset will rise. If the first currency is weak against the second currency, that means the price will come down. Okay, let me say that again. Price, when the first currency, which is the base currency, is strong compared to the quote currency, price is going to rise for that particular instrument. If the base currency is weak compared to the quote, price will drop for that particular instrument. Okay. Now, when the dollar suddenly becomes strong for whatever reason, as will be reflected in dollar index, you will see that this currency will drop. While the dollar index will rise, Euro USD will fall. Why? Because at that time, the dollar becomes stronger than the euro, or the euro becomes weaker than the dollar. Right? That's the same thing you will see in currencies like GBP USD. You will see it in gold. Why? Because the dollar is the quote currency, is on the right-hand side. So you will see the opposite relationship across all these currencies that have the dollar on the right side, which is the quote side. Now, look at currencies that have USD on the left, which is the base side. USD JPY. USD JPY will take off. As the dollar rallies, USD JPY will rally as well. Why? USD CHF will rally as well. Why? Because the dollar is in front. The dollar is being strong. As the dollar is strong, currencies that have the USD as base will follow the dollar up. Let me quickly show you what I mean. Now, look at this. Now, last week we had last week we had a last was it last week? Yeah. Last Thursday or Friday, we had a Federal Reserve make a statement, and then we see this massive drop that happened that day. Okay. Look at this massive sell. This is the dollar index, by the way. Massive sell, right? Now let's go to the Euro USD. Can you see at the same time there was a massive sell, right? Look at this. At the same time there was a massive sell, there was equally a massive buy at the same time, almost the same kind of move. Now let's check something. Look at gold. At that same time, there was a massive buy at the same time, right? Now look at Euro USD JPY. At that same time, there was a massive sell. Can you see this? Look at look at this is USD JPY. Now look at the dollar index. Can you see? It's mirroring the same kind of movement. So it will go where the dollar goes, while the other one will go in the opposite direction. We understand that. So this is the kind of impact that the dollar index has on the economy, on the markets. So another question. Good evening. First of all, Charles, does that answer your question? Another person says, Charles, I'd like to know if that answered your question. Good evening. How can I mark key levels and know the ones that we hold and why it we hold? Okay. Now, when it comes to marking key levels, first of all, there are different kinds of levels in the market. There are supply and demand levels in the market, and there are what you can term to be key levels. But for me, those supply and demand levels are much stronger than round figure, what we call psychological levels. Psychological levels are levels like these. Can you see levels like 98,500? Round numbers, right? Round numbers, 98.00. All those are round numbers. When you go to gold, right, 3,400, 3,300, all those places are round figure numbers. They are called psychological levels. So you can watch those levels. And on the other hand, you can can look at the market and try to identify areas where market had made significant pullbacks before, and you can do it on a higher time frame, let's say on the daily chart. So when you go to a daily chart, you are looking at where has price made a reversal in the past? Where did price make a reversal from in the past? Right? So let's look at this now. We'll look at this area. We'll look at this area here. And then we'll look at this area here. So these are strong areas where price had made significant moves in the past. You see? So except some fundamental event happens, fundamental events means a particular heavy news event happens. A levels, demand and supply levels like this where price had reversed in the past will definitely hold, except there is a major news event. Now look at this one. This one held and came down. So price moved like this. Price came down like this, not up like this, and then it held somewhere around here. Now, this is remember when you're measuring, when you're working on support and resistance levels or demand and supply areas, understand that there are zones, not there are zones like this. There are zones, more like zones. Where exactly price will get to where exactly price will get to um across the zone, you don't know. It could be the bottom of the zone, it could be the top of the zone, it doesn't matter. You don't know where. So just pick the zone. But when you see price reaction, you will know when price has begun to change direction. You will know. So when you see price make a huge reaction, price hits a particular level and makes a huge reaction, that will tell you, okay, price is reversing from there. This is where price is reversing from. Okay? So when you do it on higher time frames, it has a huge possibility of playing out very well, except there is a major news event. There's a major news event that drives price up. That's the only challenge that there will be. But if there's nothing like that, then of course, it's fine. This move you're seeing here right now was as a result of a particular move that happened in the market. This was a news event that happened. This huge sell here was another news event, right? So market doesn't just break out of levels anyhow. Market breaks out of levels when there is a fundamental event that's driving where the market is going next, right? So as long as there's no fundamental event driving where the market is going next, market will respect the levels that you are seeing, that you mark. Do it, like I said, do it on a higher time frame and you will see. Even here now, you can see there's likely a trend line here right now. So when you look at this, you will see that price got price price touched this, and by the time price bumped into this place again, it bought. So this is a support level. This is also a trend line area, right? And now price coming to that level here too, it turned around and made a huge buy going up. Now, when you have marked these support and resistance levels, which is demand and supply zones already, you need to now wait for price to react around there. Can't just get there and say, let me jump in. No, that's a premature way of entering the market. You have to wait for confirmation. Let the market give you a reaction. Let the market give you a pattern telling you that price is actually doing what you expect it to do. Then before you enter the trade, right? So in this space, now find a bullish pattern, a bullish buy pattern. When you see a bullish buy pattern, that's when you get on the trade. When it's at the top here, you see a bearish pattern, you get on the trade. See? So if it's not, you don't see that, you are still going to be skeptical because you know market can disrespect anybody, can disrespect you. You don't own the market. So you want to be able to trade what you are seeing in the market before you enter the market. Before you enter the market, you get on you're checking what exactly am I seeing in this market. Okay. So when US dollar index is buying, how does the US dollar index buy affect some currencies like USD JPY? That's what I just told you. I said when the USD, when you look at this currency now, the first part of it is USD. The first part of this currency is USD. So this currency now, we do what the dollar index does. Excuse me. So USD JPY now, the first part of this currency is USD. So at a moment when there's a particular huge, whether there's a huge event or not, what the dollar does is what this currency will do most of the time. But remember, it also has a component for JPY. So this one will be strong sometimes, this one will be weak sometimes. So the price action you will see here will not be exactly what you are seeing in the dollar index, right? So, but what you are seeing, what the dollar, especially during news events, when the market moves rapidly, the dollar, USD JPY, for example, will do exactly what the USD will do. USD JPY will do exactly what USDX will do, which is dollar index. USD CAD will do exactly what the US dollar index will do because the dollar is the one that is driving that move. And because it's driving that move, at that time, the dollar is stronger in this pair, and therefore it will move in the direction of the dollar. Then look at a pair like USD JPY, Euro USD. At that time, the dollar is strong. And if the dollar is strong at that time, this pair has a inverse relationship. It has a euro and a dollar pair, component. If the dollar is strong, that means this pair, remember, you trade based on the base currency. The market goes in the direction of the base currency. That's what I mean. The market goes in the direction of the base currency. So if the US dollar is strong, that means the US dollar is stronger than the euro. At that time, the market will sell. Why? Because the dollar is strong. Base currency is weak, both currency is strong. And because the market goes in the direction of the base currency, the market will sell. So market always goes in the direction of the base currency. That's also the same reason why USD will buy. Because if dollar is buying, USD JPY will buy because the currency goes in the direction of the base currency. Is that understood? Is that understood? Did you get it, Charles? Please let me know in the chat if you understand what I've talked about. Binabo, do you get what I discussed here about those key levels, those you know, demand and supply zones and all that? Charles says I understand. Okay. Oh, What are you talking about? You said Makino. Makino. My question is about Makino. Please explain further. What exactly are you talking about? So we're talking about what did you say? You said key levels. Key levels in the market are any areas in the market where market is likely to make a reversal. Those are key levels. And the best ways for you to understand key level, for you to capture key levels, is just look to your left and see what price has done before. Just come to the chart and look to your left. Those are the best key levels where market has already shown you that it has turned around before. Those are the best key levels. If you select a key level based on, let's say, okay, look at this now, for example, this is 100. And you see, price had reversed here now at the 100. 100 is what you call a key level, a psychological level. Sorry, wait. 100 is what you call a psychological level. You see how price hit that point and turned around? Now, when price ever gets to this point again, what do you think it's going to do? It will turn around. Does market always obey those important chart patterns? Yeah, market obeys those patterns most of the time. But what usually changes things is when there's a fundamental event. When there's a fundamental event playing out, either either with respect to the news or with a fundamental situation, right? In the US, for example, now there is prospects, there is the anticipation that there is going to be an interest rate reduction. Okay, now that event itself has not happened. And what effect does that have on the dollar index? A negative effect. It has a negative effect on the dollar index, which means that event has the power to weaken the dollar. But now the thing is that event itself has not happened yet. Just the announcement of it is weakening the dollar index. See? So that's what I mean by either a news event or a news situation or a fundamental situation, either a fundamental event or a fundamental situation, So the dollar index is weakening, even though the main event has not happened, right? But because there's anticipation in the market that that event will happen or is likely going to happen, the market is already pricing that into the moves that we're seeing right now. So the market will obey those patterns most of the time, right? But when there's a fundamental situation at play, then you will see that the market these levels get disrespected very easily. So that's the reason why it's always important to look at both sides of the market. The fundamental side, the technical side, you're looking at both. What's going on with fundamental? What's going on with the dollar index? Right now, what's mainly driving the dollar index is what Trump is doing with tariffs and interest rates, right? Inflation right now is muted like that. It's not really that such a big deal at this moment. So what's driving the market is the tariff situation and now the interest rate situation that's coming. So you have that in mind. Then you also look at the technical. You look at the technical. Then you know, okay, this is where the market is going to go. I can expect certain levels to be broken. For example, I could expect that price is going to break out of this level. When a particular news happen, or when by next month now, when the Fed decides to cut rates, I know that very likely price is going to disrespect all these levels. I won't even bother myself about these levels. Very likely price is going to break out of these levels. And when price breaks out, it will break out as if that level does not exist. But as long as that news event has not happened, you will see that the market tends to balance out. That's the reason why we can go and use technicals to trade. There's a certain level of confidence you have when you're trading technicals, But when a fundamental event happens or is about to happen, it changes the dynamics of the market. You see? So that's why it's good to keep an eye on all of those. Okay? Fundamental, technical, we keep an eye on that. Yes. Do we have any questions? Any other questions? Who still has more questions? Okay, for gold items, for gold, in terms of fundamental analysis, what do I do to check? Well, now when it comes to gold, first of all, you understand that at the time, look at gold, for example, gold is XAU USD. So if the dollar, gold historically has an inverse relationship with dollar. Gold historically has an inverse relationship with the dollar. So which means that generally, this is general now, because it can change based on certain things that are happening in the market. Generally, when the dollar index is weakening and is expected to weaken more, gold tends to buy, gold tends to rally. Okay? Gold tends to rally when the dollar is expected to be weak or is weak, gold tends to rally. That is one relationship you need to understand. Now, that is the same thing with Euro, USD, JP, USD, and the rest of them, right? But gold also has other factors that can play into it. So at the time a fundamental event happens and drives dollar, we see that impact in gold as well in an opposite direction. So let's look at this now quickly. You see, you have this massive sell. I even showed us already. You see this massive sell right here. When you look at gold, you will see that that's the opposite direction, right? The same thing, but in opposite direction. Okay. So now, besides this, what else influences gold? Gold is called a safe haven asset. Safe haven asset. Safe haven means that whenever there is a crisis situation in a developed country, the developed economy, you would expect gold to benefit from that. Why? Because people think of gold as indestructible. So because they think of gold as indestructible, they tend to want to move assets into gold during times of economic uncertainty. If I go back now, I show you, will discover that from the time that in 2023, when Hamas attacked Israel, gold has been on the buy side, and he has never come back since then. He has continued to be very, very, very strong. This was gold that came to 1,800. Today, gold is hovering over, gold is hitting 3,400 back to back, again and again and again. We're seeing heading to 3,400 again now. 3,384. That's just 3,400 is not too far away, right? So that's what we are saying here. This is something also you have to pay attention to. You're watching. What else is going on? What else is going on? But at this moment right now, I can't tell you that there's a fundamental event that is driving gold. What I can tell you is driving gold right now is the weakness in the dollar. The weakness in the dollar is driving gold. Also, very recently, since the pandemic, or for a couple of years now, this is something you have to understand. Gold is going to be mostly bullish. Why is it mostly bullish right now? Because a lot of central banks are spending billions to buy gold. Why? Because America has become a risky place. Because most of the time, previously, central banks held their financial assets in dollars, and they still hold significant portion of their assets in dollars and in dollar-denominated assets. But recently, the American leaders have been, stretching their reach so far. For example, when Putin attacked Ukraine, when Russia attacked Ukraine, the assets of Russia in the US was seized, over 600 billion. So right now, countries like China began to see that, oh, if I keep my assets in America or in dollars, I might have problem if I do something tomorrow. So many of these central banks, like the Bank of China, Russia, and the rest, began to spend billions. So every month now, they spend billions to buy physical gold and stock it and stash it. That's the reason gold has gone this far. So overall, you will discover that with also with the weakness of the dollar, gold is expected to remain bullish bullishness in gold is an expectation. It's expected to remain bullish for some time to come, right? Except until that dynamic changes, and it's not probably not going to change in years, because you can see Trump came in and is doing a whole lot of things as well. All of this makes other countries uncomfortable exposing themselves just to only US assets. So you can't really find news on gold in one place, except some crisis happens. Maybe if a particular huge crisis happens, then you'll be able to see, okay, the gold is going to benefit from this. Then you can see that gold is going to benefit from this. But in the event that there is no major event happening right now, then you can't really get data on gold from one place, right? So, and the way to only think about that is always think about in terms of the fact that gold is going to be bullish right now just because of some of the things I've said. So most of the time, as much as there are opportunities for a sale, you will most of the time be looking for buy opportunities, right? So yeah, if you look at Euro USD now, Euro USD sold yesterday heavily, but gold did not go in that direction. Gold is supposed to do that, but gold didn't do that. Am I understood? Any more questions? Any more questions? Yeah, understood. Great, great. That's good to know. Who else has a question? Lots of questions today that are not beginner class questions, but this is fine. It's fine. We can always have these conversations. More questions, more questions, more questions. We still have a few minutes left. More questions. We still have a few minutes left. Okay. Okay. Now, when it comes to Fibonacci retracement, what you are going to, I don't really know exactly what you mean by that question. If you ask me, I'm not so clear with that question that you just mentioned, but let me try and explain this by what I understand you to be saying. Okay. Now, when it comes to Fibonacci retracements, you are using Fibonacci retracements to try to locate where retracements are likely to terminate. So price makes a move from this bottom here to this top here, right? The question is, this is what we call an impulse move, impulse. Now, price needs to make a retracement before it continues to go up, because once price buys like this, people are going to take profit. And once people take profit, price starts to come down to gather momentum to continue in that same direction. It has to gather momentum. A lot of people can see, those who were on this trade are taking profit. Those who are not on this trade are not going to jump in. They want to get this, they want to enter this trade, but they want to get on this trade at a discount. You see? You see that this thing is going to do very well. Let's say it's a stock. This is going to do very well. But I can't just jump in and buy now because it's already started moving. Let me wait for you to give me a discount. That is what pullbacks, that is what Fibonacci is expected to help you do. It's expected to help you find areas of discount in the market. So you want to buy, but where is my discount area? That's what Fibonacci is for. So what you do is that you pick two levels. You identify a swing high and a swing low. This is a swing low, for example. Then this is a swing high. Okay. So what you do is you take your Fibonacci and you take your Fibonacci. Oh, yes. You take your Fibonacci, right? And then you mark from the bottom to the top, from the swing low to swing high. You mark from swing low to swing high, right? So what you're looking for, you're trying to target the 50% to 61% level. That is the kill zone. That's what you're looking for. 61% preferably. 61% preferably, right? So, but if you look at this now, you see that price bumped into this level. Price bumped into this level, which is a 60%, 51, 60. The top one here is a 50% level. The bottom here is a 61% level, right? So it depends on, this is the area where you want to enter trades. This is the area where you want to enter trades, right? So you want to enter around this discount area, discount level right here. Okay, that's basically how Fibonacci works. And many times you see it perfectly touch the 61%. Sometimes it will touch the 50% level. Basically, what you're looking for is that area here. Once price gets into that level, you should be expecting a retracement. Except price is not going to change. Price has already changed direction. If price changes direction from this top and keeps coming down, once it breaks the 50% and starts going below, then you know that, okay, this direction market has probably changed direction. So that's when you want to exit your trade if you've already gotten into your trade, right? But if you've not gotten into your trade at that time, then of course you know that you should be getting in. This is this level right now. You can see at this point now, you can see this massive, you can see this huge buy, this huge buy signal right here. This is a huge bullish signal, a huge bullish signal here, and that is a hammer candle, very bullish signal, and you're expecting already price to buy from there, and it is now is giving you a very strong signal for a buy. So what are you going to do? That's a beautiful buy up there, going up that way, right? So that's basically the way it is. That's how Fibonacci works. Nothing, no big deal to it. All you just need to do is just use it more, use it more, use it more. You start to see how it plays out with so many different instruments. You can use Fibonacci for all kinds of instruments, basically. I used to trade anything. You can use to trade anything, right? So it's just to understand how to use it, pick your swing highs and swing lows, understand where there are impulse moves, understand where areas where you should use it and where you shouldn't use it, right? But if you're using it properly and using it in right places, it's a very reliable tool, right? Is that understood? Or is there a further question from that? Is there further question from that, or is that understood? Is that clear? Okay, understood. Okay. So we have just a few minutes left. Who else has any more questions? Any more questions? Any more questions? We have few minutes left. Okay. So this is just what we're talking about now. So we should expect price to come back to this level because it's already giving us a signal here for a sell. So we expect that price is going to at least drop to this bottom now, right? And that's what Fibonacci has given us there. So what does the term market volatility mean? Oh, well, market volatility just has to do with the movements in the market generally, right? Movement in the market. Mostly when you hear about volatility, generally in regular business or in the regular world, it tends to connote randomness. But in the market, volatility is actually a very good thing. So it just measures how much momentum there is in the market, how much momentum, what the strength of the movement in the markets. That's what volatility measures basically. What is the strength of the movement in the market? Is it rapid? Is it rapid? Is it slow? For example, let's look at this. Look at this. Look at these two. Look at these two candles. This is one candlestick. This is another candlestick. Okay. So if you look at these two candlesticks, sorry. If you look at these two candlesticks, you notice that this is a 4-hour chart, and all these candlesticks here were formed in 4 hours. So one made a move of 200 pips in 4 hours. Another one did a move of what now? 12 pips in the same 4 hours. So volatility was massive here, volatility was tiny here. That's what volatility is. Just measures the strength of the movement in the market per time. The strength of the movement in the market per time. You see? That's just what it is. Do we understand that? Do we understand that? Understood? Nice, nice. That's good to know. All right. We're having this session. We should have this session again on Thursday. We should have this session again on Thursday. We have another session again on Thursday that is a Q&A session. So let's look forward to that. We'll end the class today. We're out of time now. So I'll see you guys on the next one. So thank you guys for coming. I'll see you guys on the next one. So let's prepare questions, and so that next time we're having our session, we'll be able to ask more questions, and let us all participate. Bring your questions, because I know it's difficult for you to come up with questions on the spot. But bring your questions with you so that we can go right into it, and we'll be able to go through all the questions for you. All right. Yes, we'll drop the recording. I'll drop the recording in the group. Okay. All right, guys. Thank you. See you on the next one.